Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. And I was just kind of thinking and wondering, how many of you are in the mood for some growth stocks? I get criticized all the time of being grandpa, and I have been doing this for 50 years, but the reality of it is most of my career I was a growth stock manager. And in fact, when I first developed FastGraphs, the fundamentals analyzer software tool, it was totally focused on growth stocks. And we've evolved now, as I have. And, I do like to look at some high quality dividend stocks and some blue chips, but, there's always room for a little growth in the portfolio. So what I'm going to take a look at today, I'm going to take a look at my 4 favorite growth at a reasonable price Chinese stocks. And, there's some very interesting opportunities here, especially in the retail side. They've had some antitrust issues and fines coming from the Chinese government. That's, of course, caused a lot of these stocks to go down. So I'm going to take a look at these stocks, if you will, by the numbers here and see what we see. The 4 that I'm going to be talking about, I named this portfolio Alibaba because it was the one that I massed throughout the most. But I'm going to look at Alibaba, JDcom, Tencent Holdings, and VIP Shop Holdings. And, they're all 4 rated investment grade companies. I think that's something that's very, very important. The consumer discretionary stocks, which is internet and direct marketing retail, would be Alibaba, JDcom, and VIP Shop Holdings. Now, the Tencent Holdings, which is actually the largest of the group, is in interactive media and services. And I did want to include it because these are probably the 4 most popular, widely followed stocks. So let's go ahead and look at them. And what I want to do is I want to look at them from strictly the point of view of growth and the potential growth that each of these companies provides. We're going to start out with the smallest one, VIP Shop here. Now, there's a couple of things I want to talk about when I'm looking at this graph. I want you to notice the price volatility. When you're dealing with high growth stocks like this, and you're dealing with stocks that, are very popular and have a great deal of momentum, you can see an enormous amount of volatility in the prices. And if you look at, VIP Shop here in March of 2012, they were trading at 44 cents a share, price adjusted. By the end of 2015, the stock had traded to $29 a share. That's an enormous rate of return that you could have made in a very short period of time. 6,606%, 306% annualized over a couple of years. But, that's a classic example of how the market can hype stocks, because when you look at it from the point of view of its peak down to its trough, over the next 3 or 4 years, you would have seen that you would have lost about 83% of your money, or turned $10,000 into about $1,650. So, growth stocks can be very, very attractive, but I believe you need to really pay attention to valuation. And growth at a reasonable price is what the theme of this particular article is. So when you look at this company, you can see that it's had, first of all, if I get price off of the graph, you can see it's had a very excellent record of growth. And I'm not even calculating it because it doesn't give me some of these numbers are so crazy here. So I'm going to shorten the time frame so that I can get you into a calculation that's pretty reasonable. And, coming since 2015, it's been growing at about 30% a year. Going to forecasting, when I'm looking at the 3 to 5 year trend line growth, the company is expected to grow about 12% a year going forward, which would indicate that it's very attractively valued at today's levels. And this could end up leading to, double-digit returns going forward. Talking about performance, let's look at the company's historical performance. Now, I want to go back on here. I'm going to maximize this graphic, and I want to look at the total performance here, because this company came out, with a valuation it was really hard to imagine. We're putting a normal PE ratio here, which I don't have on the graph right now, of 32.78. And we're using just a simple 15 PE ratio as actually a valuation reference here. And I want you to note is that, this stock has averaged over 53% compound growth. Now, what's interesting about that, if I take this and look at it from the standpoint of sales growth, and this is a new feature on the new version of FastGraphs that we haven't launched yet, so those of you who are subscribers don't get excited, because I'm excited about it. But this would be price to sales. You can see this company has, the number here is 1.15 times sales. That's, a very, very manageable, reasonable price to sales. And you can see that when the price to sales got up here into 3.25, so to speak, 3.3 times sales. That was a very dangerous time to own it. More recently, it got up to 1.5 times sales, and that turned out to be a relatively dangerous. But the company is also traded at much lower price to sales numbers. So I do want you to be aware of that as you're looking at, at this particular graph. But nevertheless, this has been a tremendous performer based on the fact that they've now had, this, what I'll call Chinese, governmental threat. The stock has corrected from being overly valued into fair value territory. It's a very reasonably priced stock today. Looking forward, based on estimated growth, this could be a double-digit rate of return if it maintained, a high growth rate and traded even at a minimum 15 times earnings. So this is the smallest of the group, and then, that might make an argument for why it might have some of the best growth potential. The next one I want to go into is JDcom. This is a $93 billion market cap, total enterprise value of $102 billion with 10% debt to capital, BBB plus rated. The earnings yield here is low. This is one of the natures of growth stocks. There's a couple of lessons that the JDcom, I think, graph really tells us. Number one is the growth here has been absolutely phenomenal at about 59% a year. I want to look at this one from the standpoint of sales also, because the sales growth in this company has been about 34% a year, and it's forecast to continue to grow at a pretty high rate of sales going forward, at about 20%, 19.5 to 20% of sales going forward. So, you can see that the normal price to sales here has been about one, just a little over one, and it's currently trading at below that right now at about 0.89 times sales. So it's a bargain if you're looking at it from the perspective of sales. From a standpoint of PE ratio, using the P equals growth rate, because this is a very fast-growing company, it also looks very inexpensive as well, and I want to make that point. But I also want to talk to you about performance. When you look at performance here, notwithstanding all the growth that this company has achieved, you're going to discover that the performance has been relatively benign, if you will. 16% is nothing to sneeze at. Going back to 2014, almost tripling your money with no dividends, of course. But the problem is this was a very poor investment because it was losing money during these years. The stock price went nowhere until it got into fair value in December of 2018. But that's using a very high multiple as fair value. I want to make that clear. But you'd have actually lost an annualized loss or total annualized rate of return of minus 3.8%. You'd have had, in a $10,000 investment, you'd have actually had purely 16% of your money dissipated, turning $10,000 into $8,372, simply because the company wasn't making any money, but, the stock just languished, even though it did have some periods where it rose and fell, as the stocks always have. But since it got into this fair value territory, the rate of return has been phenomenal over the last couple of years, annualizing it over a 66% annualized rate of return. So, the standpoint of performance here is really kind of interesting, because the performance jumps up to 65%, as I indicated a minute ago. If you shorten the time frame just since 2018, 10,000 would have actually tripled. You'd actually made more money owning it for the last 2 years than you would have for the whole, history of this company. And again, the price to sales right now is very, very reasonable relative to its historical norms. So let's move on now. Let's go to Alibaba. This is one they were just fined. By the way, there's a very interesting aspect of Alibaba here that I want to show you. Alibaba has actually been in a downswell here because for the first time since they were public, they actually lost money on a quarter. That was the March quarter of 2021, which is their fiscal year. But what's misleading about that is if I look at it for, total revenue growth has actually been strong. And we'll look at that here a little closer. But I want to point out that this company's average growth of about 35% a year. If I look at performance, it's only been about 14% a year. But once again, we have this pesky valuation that comes into play. If I shorten the time frame where I get a little better valuation, my performance, kind of adjusts a little bit. But the point is, if you buy this stock at a reasonable value, you can do well. You don't want to overpay for it, because if you overpay for even these nice fancy growth stocks like this, you can end up with years of negative rate of return. And by the way, something that's always overlooked when I make these kind of statements is how much risk you're actually taking. Now, if I look at Alibaba from a standpoint of price to sales, this company normally is traded at 10 times sales. Okay, it's currently trading at a price to sales of about half that, about 5 times, sales. So that's, very, very interesting relative to its historical norm. So is this a bargain? Well, it may be a bargain. It really depends on what happens going forward here. When I look at the 3 to 5 year trend line growth, the company is expected to grow at almost 28% a year. This would make it a great bargain based on earnings as a result of this drop, if it did give us this growth rate. Now, what's a little troubling is near-term growth is expected to be a little less than that. So that's something that you'd want to take into consideration. But the big drop in price has probably bought this stock into a reasonable buy. It's trading at half its normal price to sales, and it's probably a very attractive buy here, notwithstanding the fact that they actually did have their first loss in a quarter, but that was primarily because they had to pay a fine. Because if I look at it from the other point of view, their revenues actually stayed very strong, as I showed you a moment ago. Anyway, the biggest of the group here is a company that's actually an interactive media and services sub-industry. That's Tencent Holdings. This is the largest of them all. Its average growth has been over 30% a year. Long-term performance on this company has been 38% a year. If you bought this stock in January of 2008 and put $10,000 in it, it'd be worth $576,851 today. So that's clearly a classic, quintessential example of a growth stock. From a standpoint of 3 to 5 year growth going forward, it's still expected to grow at about 25% a year. So again, it also looks very, very attractive. But keep in mind, you're paying high multiples, high PE ratios, high price to cash flow ratios, et cetera, when you're investing in all these stocks. So that's something that you always want to take into consideration. When I look at it from the standpoint of price to sales, we see that it's normally traded at about almost 10 times sales. That's about what it's trading at now. So it's not necessarily a bargain, but it's a good value. And if it continues to grow sales as expected, this would, be a 20% annualized rate of return producer over time. The point is there's a lot of growth. This is an A+ rated company with only 25% debt. That's another thing I think you really want to take into consideration. This is, it does have a very high quality credit rating, and it's an extremely attractive company. I also want to look at one last thing here. I want to take a look at a company like Alibaba, and I want to look at it from a standpoint of free cash flow, because cash flow is really what these investments are all about. Now, this is the one that I was asked about the most, as I mentioned earlier. So I want to take a look at it from a standpoint of free cash flow. It's trading at a very, very low multiple relative to its historical norms. It's typically traded at around 30 times free cash flow. 32.68 is what's on here. If I put the normal price to cash flow on here, it's slightly different at about 30. But the point is, it's 30-ish times cash flow, and you could currently buy it at 20 times cash flow, which is another indication that the stock is a bargain. So these Chinese retailers and media companies do have an awful lot of growth. They've made investors a lot of money historically. The recent sell-off with some of the antitrust issues from the Chinese government could perhaps have created a great opportunity to buy, very high growth at a reasonable price. Anyway, you might want to take a look at these closer. There's a lot of research I believe should be done before you buy these stocks. Anyway, I hope you enjoyed this video. If you did, give me a like, ring the bell, subscribe to my channel, because I'll be covering this kind of stock as well as many others, including the good old faithful dividend growth stocks in the future. Thanks for watching.